In very direct and simple terms, I think this is one of the greatest investment opportunities I've seen in 25 years of doing this. And what I mean by that is that doesn't necessarily mean I know exactly how it's going to go. And it doesn't necessarily mean it's going to be a smooth ride. But what I mean is that when you stand back and you look at the big macro picture, everything is about...
The government shutdown has ended, but the Bureau of Labor Statistics announced that a lot of data will simply never get released. The markets have been dumping, everyone has a different theory why, but the one thing they all agree on is sentiment is terrible. Hello and welcome to Milk Road Macro, the podcast that knows that the market can't rally until after you sell. I'm your host, John Gillen. Today is Monday, November 16th, and we are joined by Brent Johnson. Brent is the CEO of Santiago Capital with over 25 years of experience in financial markets. He previously served as managing director at Baker Avenue Asset Management and spent 9 years at Credit Suisse in their private client group. Brent is a genius, one of my favorite commenters on the market. He's going to make the green candles come back. So if that sounds good to you, make sure you like and subscribe. Share this episode with someone who's going to enjoy it. And as a reminder, if you are watching on YouTube, make sure you're subscribed there. But if you're watching on another platform, give us a 5-star rating. Really help us grow the channel, get the message out there, and bring this great content to you all. Today's episode is brought to you by Quicknode, the Web3 engine trusted by top teams to build fast, scale instantly, and never go down. And without further ado, welcome to Milk Road Macro. Brent, how are you, sir?
I'm good. Thank you. That was a nice introduction. I think I should have you talk to my wife and let her know what a genius I am.
Well, I'll be happy to give you my rate anytime. I'll send you an invoice. Brent, I thought a great place to start this conversation would be with some of your recent work on stablecoins and how this is affecting geopolitics and sort of these competitions between governments over currencies. But first, I'd like to start with your famous dollar milkshake theory. I was watching a podcast this weekend and Jordy Visser asked Anthony Pompliano if he knew who you were. And he's like, yeah, the milkshake guy. So you're very well known for this theory, but a lot of people don't really know what the details of this are. Just briefly for our audience who might not be familiar, what is the dollar milkshake theory and why is this so important to understand right now?
Yeah, I'll be happy to kind of tell you what it was. I noticed when you first reached out that it was a Milk Road macro, and I was happy because if it was Milkshake macro, I was going to have to call up my lawyer. But no, okay. So the milkshake theory is actually, it's blown up into something that I never expected it to be. It was essentially an analogy that I came up with to try to explain to my clients what I thought was going to happen in the years ahead. And when I first started talking about this, it was the 2018-2019 period. And if you remember back then, interest rates were at or near zero. And I thought we were at a point where interest rates were going to start to rise for basically the first time in 40 years. And as that happened, I thought that interest rates rising in the US would cause the dollar to get stronger. And I thought that would simultaneously pull capital into the United States, which would then create a higher dollar as well. But it would also push up US assets. But I thought it would be the higher interest rates because nobody had dealt with that in 40 years. I thought would also lead to great volatility. And that volatility would create terrifying drawdowns along the way. And as those terrifying drawdowns happened, I thought it would potentially send us into some kind of a sovereign debt crisis. And while the U.S. has many financial sins that it needs to pay for, I thought the rest of the world has those same sins. And on a relative basis, I expected the U.S. to come through that crisis better than the rest of the world. Now, the interesting thing is we never got the crisis. We got pretty close in 2020 with COVID, and we got close again in 2022 when the Fed was raising interest rates. But ultimately, it has not happened. But the asset prices, the effects that I thought that this would have on asset prices has turned out to be correct. U.S. equities have vastly outperformed the rest of the world. The dollar is higher now than it was, 10% higher now it was when we first started talking, despite all of the stimulus, despite all the bailouts, despite all the money printing. Gold is significantly higher. And at the time we had said that the dollar and gold would rise together versus fiat currencies, which has played out. So while we haven't had the crisis of the dollar milkshake theory, the framework has worked out really well for us and helped us understand what's going on in the world. And I think it continues to be correct today. I haven't heard a better overall framework for understanding what is currently happening in the world. And it doesn't mean that it's guaranteed to be right, and I can obviously be wrong, but so far it's served me pretty well.
Yeah, and I think that there's a lot of pieces to that theory. The way I've always kind of like explained it to people is just the general idea that the dollar is the cleanest dirty shirt in the laundry. And like you said, like we have problems with our currency as well, but other nations have them and have them worse. So the dollar tends to strengthen against other currencies as they weaken. You've kind of built on this work a lot recently. You gave a presentation, I think only a few weeks ago, at the New Orleans Investor Conference called Our Currency, Your Problem, all about how the rise of stablecoins are sort of accelerating this dollar dominance in the world of currencies. Explain to us a little bit about this thesis. How are stablecoins posing such a threat to non-dollar currencies in the world? Why is that important right now?
Well, I don't think it has really happened yet, but I think it has the potential to happen to a very great extent in the months and years ahead. And the reason is because stablecoins have been around for 10 years now. So they're not actually all that new. But I think the current market of stablecoins, to a certain extent, helps make my case for me. Because out of all the stablecoins that exist, that include many different currencies, gold stablecoins, cryptocurrency stablecoins, the U.S. dollar stablecoins make up 99% of market share. And that's not because the issuer said, we're going to force these dollars onto this new digital world. That was these distributors or these issuers responding to market demand. And it clearly shows that there's huge demand for dollars in the crypto world. The reason this can be a big deal going forward, and part of the reason I probably missed it initially, was because the early issuers of stablecoins, I felt were, maybe the best way to say it is just not exactly up to standards of my typical investments, right? That's probably the polite way to say that. And so I probably just stayed away from those and probably didn't analyze them to the extent necessary. The other reason is I have always said, whether it's regard to Bitcoin, whether it's regard to ETH, whether it's some other digital assets, I don't know who will ultimately win this battle. But I do know that if those digital assets, those digital currencies, were to come into conflict with the United States and the United States government, the United States has many cards that it can play to fight back. Now, again, I don't know who would win that battle, but there would without question be a battle. And the reason is you cannot remain a country for very long if you do not have sovereign control of the currency that is used. And that kind of plays into my stablecoin argument for why this could be a big deal going forward. And so it was for that reason that I probably did not initially take as good a look at these as I probably should have. So that's on me. But with the passage of the Genius Act, that kind of changed a lot of things for me, because it forced me to go look. Because I kind of hate politics and hate politicians, but it doesn't matter if I hate them or not. They influence the world in which I operate. So I have to pay attention to what they do, even if I think they're a bunch of jokers. And in this case, I don't think that they're I think they're actually pretty damn smart when I look and see what they did. Because with the passage of the Genius Act, they sort of codify by law the ability to use this private market innovation to their advantage. And the ironic thing is, I think this technology was launched as a way to subvert official control, for lack of a better word. But these geniuses behind the Genius Act, I think, figured out a way to co-opt that private market technology in a way that will kind of surreptitiously, help them remain the global reserve currency and enforce their monetary dominance. Now, that's a very long way of saying that the U.S., via the Stablecoin Act, has somewhat officially blessed the existence of these stablecoins. And if they've kind of given them their blessing, the likelihood of them coming into conflict is dramatically diminished. And I think what people have traditionally, at least so far from what I have seen, it doesn't mean that I have exhausted all the analysis on this, but the analysis I have seen seems to focus on the fact that this is a way to perpetuate the United States because it's a way to soak up treasury issuance. And this is a way for the U.S. Treasury to find new buyers for its bonds. I believe that is sort of true, but to me, it's a total sideshow to the real advantage from a United States perspective. And what I think the real advantage is is that because there is so much demand for dollars outside the United States through the traditional euro dollar market, and I don't know if your audience is familiar with the euro dollar market or not, but that's a very important part of this overall framework, is that traditionally, if you live outside the United States and you were an individual or a small business or a small, family, I'm not talking about Fortune 500 companies, you wanted to protect against your local fiat currencies. And again, around most of the world, however bad you think the US dollar is, their local currencies are even worse than the US dollar. So whereas Americans, we may look at the US dollar and say it's not a very good currency, the rest of the world, or much of the rest of the world, looks at it and says, I would love to hold dollars because it's so much better than mine. There's only been a few channels by which they could do that. They could hold on to physical US dollars and put them under their mattress, which is not always the most efficient. Or in some places, you can hold a US dollar balance in a bank, through that government's, jurisdiction and legal framework. But if it's in the system and it's under, let's say you're a Turkish citizen, you hold a US dollar balance in a Turkish bank, those Turkish monetary authorities can put capital controls on that. They can make it very difficult for you to withdraw those funds if you ever need it. They could actually confiscate those funds if they needed them. But with a stable coin, you don't need to have a bank account. You don't need to have, a big company. As long as you have a digital wallet on your smartphone and you can access the internet, you can accept payment from a US dollar stable coin. And now all of a sudden you're holding a US dollar balance. And it's not that it's impossible for the other countries to stop this, but it's hard for the other countries to stop this. And if it's hard for them and they still try anyway, that's going to cause other problems for that country, whether it's the imposition of capital controls and the negative consequences that come along with that, or a similar type of thing. And so by the launch of these stablecoins, you've dramatically increased the ability for citizens in these foreign jurisdictions to opt out of their local currency. And when you opt out of that local currency, you are simultaneously opting in to the United States currency, and it extends the United States influence on the other side of the world. And so that's I kind of rambled on there, but that's it in a nutshell. And in any country that cannot control the money within their boundaries, within their borders, will not remain in power for very long.
Yeah, and I think that's something that we're still seeing the early stages of what the impacts of that are going to be. The European Union has announced that they're going to try to fast track a CBDC, like you said, to bring more capital controls and surveillance to the people who live in those jurisdictions and their balances. China is really pushing now harder on trying to get adoption for its CBDC. So there's definitely a brawl that's brewing between nations and central banks around this. Something I've been really wondering about, and I'd love to get your thoughts on this, is whether or not you've gotten to a point yet where this thesis has developed for you enough where you're articulating this in the market somehow, right? Because a lot of people who are crypto native, like our audience, are familiar with stablecoins, but it's not really easy to find a way to invest in this, right? It's like, do you short the banks? Do you go long on certain stablecoin companies? So what are your thoughts on that as an investor trying to articulate a thesis about this in the market? Do you have a thought on that, or how are you thinking about that question?
Well, to me, it kind of reinforces my whole dollar milkshake theory, right? It's a natural extension of it. And it tells me that despite all of the comments and despite all of the headlines, de-dollarization, it's not that it isn't being attempted, and it's not there isn't desire, but the success of de-dollarization is largely a myth. And I think we could very much get into a situation where the world is dollarized or more dollarized as opposed to de-dollarized. And as a result, I think that has huge implications for capital markets. The problem with a strong dollar versus other currencies is that causes a lot of pressure in the rest of the world. And the pressure in these rest of the world often then gets exhibited through some kind of a credit crunch or a high volatility event. And when that happens, liquidity typically disappears. So I'm always on the lookout for where could this rogue wave that would cause another 2022 or 2020 or 2008 type scenario where credit is suddenly constricted, liquidity disappears, and we very quickly transit from a benign and happy environment to a very critically volatile and negative environment. So I'm always on, and so I think this has the potential to do that. And when I say things like this, people say, well, that will bounce back and hurt the United States as well, Brent, then your thesis is flawed. The U.S. getting hurt is part of my thesis. I just want to get that. I don't want anybody who's hearing this for the first time to think that I think the United States is immune to this volatility and is not going. I think we have 4 different scenarios that the world could go through in the years ahead. And I've talked about these before, but I think they remain the 4 most important things that I think about. One is perhaps all of this worry about a rogue wave or a negative market event is totally unfounded, and we're all going to grow together over the next 5 to 10 years. And, this AI innovation makes the whole world more profitable and and we have a bull market for the next 10 years, in which case don't really need to worry about anything. The other thing that could happen is all of these problems are real and they're going to show up very quickly and the whole world goes down together. We could have some kind of a situation where the U.S. continues to hang on and does well on a relative basis to the rest of the world while the rest of the world falls. Or we could have a situation where the U.S. falls and the rest of the world hangs on and does better. Now, I don't know for sure which of those 4 things will happen, but I think the last one, the 4th one, where the United States falls and the rest of the world does really well, it's not that it's impossible, but it's a very, very small probability based on the design of the system. So it's not that I don't think about it and I say it's an impossibility, but I think the other 3 situations are probably much more likely than the 4th. And in any of the first 3 events, I would rather be invested in the United States than be invested abroad. And so while I'm not saying that the U.S. won't get hurt, I do expect the U.S. to kind of get hurt in this, probably going to bleed. I think the United States has the ability to withstand a knockout punch to an extent that the rest of the world cannot. And I think the United States has the ability to throw knockout punches that other countries do not. And so as a result, I've kind of sticking with my overall framework that I want to be invested. I want to be invested in the United States. I want to have minimal investments outside the United States. And I will need to be prepared for these terrifying drawdowns along the way. Of one of which I think we're probably overdue for one of these terrifying drawdowns. I thought we were going to get a hard correction in Q3 and we didn't. I think when you make these calls and you get them right, you should be able to hold up your hand and say, look at me. And I think when you get them wrong, you have to hold up your hand and say, I was wrong. And so I was wrong. And in this business, when you're wrong, you just kind of got to admit it and move on. But that's where I think we are. I think in the years ahead, U.S. assets will go much higher, but I think we're overdue for a correction. But I think the U.S. is still on a relative level in much better position than the rest of the world. So that I'm positioned as such.
If you're building on chain, your infrastructure shouldn't be the hard part. Leave that to the new Quicknode platform, trusted by Circle, Coinbase, and Binance. With Quicknode, you get ultra-low latency, 99.9% uptime, and seamless scalability across 75-plus supported blockchains. With Quicknode, your infrastructure just works, so you can focus on what really matters, building. Go to milkroad.com/Quicknode and explore the new platform now. I want to ask you a little bit more now about sort of where we are today and get your thoughts on some of the things in the market and the Federal Reserve. Because just like you said, like there is a bit of a correction going on in the markets right now. The government shutdown is what some people have blamed this on. Now that that's over, are you expecting this market correction we're in to sort of continue, or is the short-term pain over? Is the worst behind us, or are we just getting started? Like, what's your read on where we are in the markets right now?
Well, ironically, I actually think the fact that the government shut down is part of the reason that my Q3 and early Q4 correction prediction was wrong. Because when you're in a strong trend like we have been since April, up and to the right, you need some kind of you need one of 2 things. You either need a catalyst to then to reverse things and send things lower, or you need a lack of new buyers showing up, in which case it just kind of rolls over slowly and falls. Ironically, by the government shutting down, there was a whole host of government-issued data that was no longer published for 4 to 6 weeks. And a lot of monetary policy circles around both labor statistics and inflation statistics. So we had a full month, maybe a little bit more, where none of those statistics were published. Some private industry data came out, and that kind of helped. But we didn't get a lot of the signals that could have turned this lower. Ironically, now that the government is open, it's possible we get a whole lot of a deluge of information all at once. Now, I noticed last week the White House come out and said, well, we're probably never going to release the October labor statistics. So I don't know if that's going to happen across other different statistics or not. But my point is now that the government's open and all of this data can start being released again, at least we have the potential for some negative signals to hit the market that could then push things lower or contribute to a correction that we didn't have when the government was closed. The other thing is now that the government's back in business, you know, they're free to make a bunch of stupid decisions, which could which could push the market lower. The funny thing is if you go back and look historically at times when the government is closed, the market tends to do pretty well, and I think it's because they're not in there screwing things up. I joke.
Yeah, they've never done that before.
There's truth in every joke, right? And so,
right.
Mostly, though, I just kind of feel like we're overdue. I don't have a specific catalyst, and I'm not saying that everybody needs to sell everything that they have and move to the top of a mountain and wait for this biblical crash to come. And by the way, I'm not in the depression camp. There's a lot of people who are in the recession, depression camp. I expect a correction, but then I expect assets to go higher after that.
Gotcha. Okay. So you're expecting the correction to sort of continue, but then a recovery afterwards. That's helpful to just know how you're thinking about this. And yeah, I think the data not being released is interesting because I'm not quite sure how much that is going to just like spook people just not having the data. But it has created a lot more uncertainty, which the markets abhor. And one thing the market's very uncertain right now is about the Fed rate cut decision in December. Powell has said that the rate cut then is, quote, far from certain. And now the market has come down to about a 50-50 bet on whether or not he's going to do that. What do you think the Fed is going to do at that meeting? Are they going to lower rates? And then the other question is, do you think that they should be cutting rates, and by how much? Like, what is your view on that going into December?
Yeah, so I think when Powell says it's data driven, I actually believe him. I don't think that they've made up their mind yet. And part of the reason I think the Fed is a reactionary agency. A lot of people will say the Fed is behind the curve. Well, yeah, in my opinion, they're designed to be behind the curve. They don't want to be way behind the curve, but they want to be a little bit behind the curve because they wait for the data to come in and then they react to it. Considering how bad some of their decisions are, even when they already have the data, I think that's probably good, because if they can't figure out what to do when they have the data, what the heck makes people think they should be predicting the data and being ahead of the curve? But I think probably that they will cut. I don't know for sure, but I think probably that they will, especially if we get some market weakness between now and then. And I think the reasoning that they would use was, we can always raise rates again if we need to. So I don't think that they're going to cut 50 basis points. And I don't think, and I've never been in the camp that there's a lot of people think they're going to get like 4 or 5 cuts next year. I don't think that is the case unless we get significant market weakness. In other words, what are the markets going to be doing that necessitates 4, 5, 6 more cuts next year? I'm not saying they can't happen, but I don't think markets are at these levels and we get 5 or 6 cuts next year. I think more likely maybe if markets just kind of hang in these areas, maybe we get 2 cuts, 3 cuts. But again, for them to go into an aggressive cutting cycle, I think we need to have markets that are not necessarily crashing, but weakening. And then I think you could get that.
I want to kind of ask you some thoughts on next year, but first I want to stay with this question of data and how it impacts the Fed's decisions. The SF Fed released a study, I think this week or last week, and they examined 150 years of U.S. tariffs, and they found that it leads to lower inflation and weaker aggregate demand. In other words, it dampens the economy, dampens demand. That usually results, they said, in increasing unemployment. And it seems like the Federal Reserve, at least in recent months, has been more concerned about inflation. And this report seems like they should be more concerned about unemployment. I don't know if you've seen the study from the SF Fed yet, but are you more concerned right now about the risks to the economy from inflation or from unemployment? And what do you think is really going to be the thing that's driving the Fed's choice when we get into December?
So my answer is going to sound like a cop-out. And I know it sounds like a cop-out because I used to accuse the other people of this exact same thing. I used to hate it when people would say the word stagflation because I felt like they were just not willing to make a call, right? Whether we have inflation or deflation. But what I would say is I think we're going to have a little bit of both. I do think the bigger risk is deflation. In other words, my base case is that prices kind of stay where they are. Maybe some assets price or some prices fall, some prices rise. But in general, I think inflation probably stays somewhat close to where it is now. But I think the danger, and I think this kind of hints back to the SF study that you were talking about, and it's important to understand this, is that in a debt-based market or a debt-based money system, the bigger inflation to me is they're always increasing the money supply. They have to do that because it's a debt-based money system. But when you increase a debt-based money system, when a default starts, it has the potential to cause another default and another default, and you can very quickly spiral into a severe credit contraction. And when you get a severe credit contraction, asset prices fall. When asset prices fall, then people lose their jobs. When people lose their jobs, they can't buy as many goods. As when people can't buy many goods, inflation comes down, right? And I think that's where we're at now. I believe, and this is on as far as rates go, my base case is that rates are going to stay in this range or go higher. But I completely understand those who are saying that rates are going to fall because we're going to have some kind of a miraculous crash and yields are going to fall as people rush to treasuries. That is not my base case, but I get it because that is, in my opinion, the bigger risk. I think we have a much bigger risk of a deflationary crash than we do of an inflationary boom, if that makes sense. In other words, I don't think we're going back. I don't think we're headed back to the inflation that we had in 2021 and early 2022. And if maybe we will, I don't know. And that's the other thing in this business. When you don't know, you should just probably say you don't know rather than just making stuff up, right? But my base case is that we kind of stay at this level of inflation and this level of interest rates, potentially drift a little bit higher. But I'm prepared for a deflationary move if it comes. That's probably the best way to say it.
The nice thing about macro is nobody knows what's going on, so anybody can do macro analysis.
Well, and the other thing is with macro, I mean, you can have a very good idea, a very solid understanding, and actually be right, but it might take 5 or 10 years for that to play out, right?
Yes, absolutely.
And these things always take longer than you think that they should.
Yeah. So I want to ask a question about something you raised there, which is this idea of like this credit crisis or this liquidity crunch that could come. And it's funny you mentioned that because there's been a lot of rumors about similar things happening. Yep. The Federal Reserve obviously has announced an end of quantitative tightening on December 1st. There's been rumors that at the New York Federal Reserve, led by President John Williams, there's been a lot of meetings with Wall Street banks addressing just concerns about liquidity tightening. Banks borrowed, I think, around $50 billion from the standing repo facility. And so, look, this is just rumors, right? Like there's no Lehman Brothers moment happening necessarily, but it started to raise concerns from investors. How concerned are you about this? Do you think this is just, normal functioning of the markets, or like what are your thoughts on this in terms of the liquidity situation here?
Well, I think it's a real thing. I don't know that it's going to turn it into a crisis. I think it probably will not at this point. But again, I'm always ready. I'm always trying to figure out where could the crisis come from. And this is a place where it could absolutely come from. I think this is why they stopped QT, right? Because they saw this developing and the first step is to stop QT. The interesting thing about this, and I'll refer back to, and I think part of the reason people are worried is what happened in 2019. There was a repo spike in 2019 that kind of came out of nowhere. And that's the thing, going back to what I was talking about, a debt-based monetary system, once capital stops flowing, it can constrict, it can go from stopping flowing to then constricting very, very quickly. And I think that's why you always have to be prepared for it. And I think the Fed saw it was starting to slow, repo was starting to pick up. And perhaps they didn't want to cut rates aggressively because you got to remember the Fed cutting rates aggressively sends a signal to the market as well, and not always a good one, right? If asset prices are at their all-time high, and the Fed starts cutting aggressively, what do they see that we don't, right? Why are they cutting so aggressively? So I think they're right to stop QT, and I think they're right to probably have a call with the banks and say, hey, what's going on? What do you guys see? My guess is that, if you look what's happened over the last 3 months, even though it hasn't shown up in asset prices, the credit markets, not just the repo markets, the Tricolor bankruptcy and the other, private debt markets are starting to decouple from asset prices. And, there's always this theory that the fixed income guys are much smarter than the equity guys, right? And when the credit markets start to show a sign, the equity market should wake up and pay attention. And I think that's right. And so that's part of why I think we're overdue for a correction. I'm not currently in the total crisis phase. That's probably the best way to answer it.
Well, if we enter the total crisis phase, I hope you'll let us know. But yeah, I think this kind of fits in line with what you said about kind of expecting us to be sort of due for a correction, some short-term market weakness. A lot of analysts are looking ahead to 2026, though, and feeling much more constructive and bullish on that year for a lot of reasons. And I wanted to kind of get your thoughts on this. In one of your research reports for Santiago Capital recently, you talked about the impacts of the Big Beautiful Bill. And sort of this effort by the Trump administration to homeshore a lot of industries back to the United States, building out these efforts and so forth. A lot of this doesn't really start to happen in terms of real impact until 2026. What are you expecting to happen once it starts to play out in the markets? And where are you looking in terms of opportunities? Where should investors be paying attention in terms of opportunities that are going to come from this? How do you see this playing out in 2026?
Yeah, so in very direct and simple terms, I think this is one of the greatest investment opportunities I've seen in 25 years of doing this. And what I mean by that is that doesn't necessarily mean I know exactly how it's going to go. And it doesn't necessarily mean it's going to be a smooth ride. But what I mean is that when you stand back and you look at the big macro picture, everything is about the United States and China. Everything pivots off of that relationship. And I am of the opinion, I don't think this is a unique opinion by any means, but, this divorce is going to happen. Now, it's just a matter of whether it happens somewhat amicably or whether it happens really violently, but it's going to happen one way or the other. And as that divorce happens, the United States must, if it wants to retain its place in the world, it must become self-sufficient in an area that's called that they themselves, the government themselves, classifies it as covered technologies and critical minerals. And I think a lot of people know about the AI and the chips, and I think a lot of people that the batteries. China kind of has in the magnets. China kind of has a stranglehold on this part of the manufacturing process. The good news for the United States is that they are now aware of this and actively working to thwart it. The bad news is that we're not there yet. But the reason it makes it this problem creates an investment opportunity, and that is the government is going to do whatever it needs to do, whatever it takes to solve this problem. And I don't think too many people know about this, but as part of the Big Beautiful Bill, there's a small office within the Pentagon. It was actually established a couple of years ago under Biden. But when Trump won, he appointed a new guy named Steve Feinberg. Steve Feinberg used to run Cerberus, which is one of the largest and most successful private equity firms in history. This is not a guy that likes to lose money. This is not a guy that likes fraud and abuse. And he has been tasked with solving this supply chain problem on behalf of the United States. The Big Beautiful Bill is essentially a 21st century Manhattan Project to become self-sufficient from the rest of the world. And they are at the highest levels of government, in all different branches of government, they are treating it as such. I don't know exactly how this is going to play out. I don't know that it will work exactly how they want it to, but what I do know is they're not asleep at the wheel anymore. And they are going to use all the power that they have to solve this problem. And that is going to create a tailwind to invest in this critical technology or covered technology and critical mineral area. I'm lucky. It's funny because this Office of Strategic Capital, it's not a secret. It's not classified, but it's also not that well known. So far, you probably heard about this over the summer. The U.S. made an investment in what's what's it called? They got the Mountain Pass mine in MP Materials in California, which is a rare earth company. They made an investment there. They also took a position in Intel because of the strategic importance. This is coming from the Office of Strategic Capital. When you hear these headlines, they don't always say the Office of Strategic Capital, but this is where it's coming from. So they're going to make some direct investments. And the reason I like it is a little different than a typical government program. It's not some career bureaucrat or a career army general who's gotten an allocation of $50 billion that they just have to hand out to their friends. This is, run by Feinberg, who is going to be partnering, either investing directly or partnering with firms whose job it is to allocate this in a meaningful and efficient and market savvy way. So while they will make some direct investments, the real program is to partner with the private market. They're gonna choose 12 to 24, different private equity funds or private investment managers who will put their own capital at risk, and then the government will match it, and then they will come out and co-invest in these companies to make them profitable. It just so happens that we are fortunate enough that we were not chosen as one of these companies that the government is going to partner with, but we do have a way to access this. I'm very fortunate that we do have a way to access this, and so we're going to be participating in this program. And I think it's right now the only way I know of to invest in this is to be an accredited investor. So if there are any accredited investors, I'm happy to talk to them and tell them how we're doing it. This is not a sales pitch. It's not a recommendation, because I don't know who exactly is listening. But I can tell you how we're doing it and why we're excited about it. But that is probably the area that I see the most potential in.
Thanks for that overview of the program and this comments on the Office of Strategic Capital. I didn't know about that, so I think that's really helpful to know. And like I said, you've been very focused on this. What is the impacts of these things and how this is going to play out? A lot of people are kind of skeptical of this, right? Like that there's going to be a lot of capital expended, a lot of hand wringing and so forth, but that it's still sort of going to amount to a mostly futile effort, and we're still going to have these interdependencies on other nations. Do you have a view on that, or are you agnostic and just say, hey, it's happening? No, I do. So
I have a pretty strong view on it, and that is that I understand why that view exists. It's hard not to look at some of the decisions our government has made and mistakes that they've made, and not be skeptical and cynical about the possibilities. But you always have to remember that the United States is not competing against perfection. They're competing against other flawed countries and other flawed economies. And while China certainly has a stranglehold on a few things, they don't have a stranglehold on everything. And there's some things that China needs that the United States has a stranglehold on. So this is far from a given of who comes out on top. And the United States, despite all its flaws, and there are many, is still the United States. It is still the global hegemon. It still has more resources and is closer to being self-sufficient on its own than any other country. That doesn't mean it's perfectly self-sufficient, but closer to being self-sufficient. And the United States has never lost a battle it had to win. Now listen to what I'm saying. I'm not saying they've never lost. I'm not saying they can't make mistakes, and I'm not saying they can't be beat. I'm saying they have never lost a war or a battle that they had to win. And if you are betting against them, just think about who you are betting against. You are betting against the global hegemon. Now, perhaps the global hegemon will lose, but they're not going to go down without a fight. And, I always think back to 9/11, right? Which was a tragedy, probably the most recent tragedy for the United States that a lot of people can remember. And when the Twin Towers came down, I think there was, what was the numbers? 10 tons of rubble in lower Manhattan. And they said it would take 2 to 3 years to clean that up and make it able to be built upon again. And they got it done in, I think it was 12 months or less than 12 months. Because there was a unified spirit and there was a national emergency that needed to be handled. And to me, that's who you're betting against. When you're betting against the Office of Strategic Capital, you are not betting against the politicians in Washington, D.C. You're betting against the people that are working in the factories and in the startups and in the trenches of trying to make the United States self-sufficient again. And for all the American fatalists who think that there is no way the United States can win, I will take the other side of your bet. And I'll just probably leave it at that.
Brent, that is one of the most beautiful odes to America that I've ever heard, and one of the most bullish things I think I've ever heard anyone say on this podcast. As a last couple of questions here, just to wrap up, we talked about 2026. We talked about this dollar milkshake theory, how some of these things are playing out, and we're kind of in a bit of a dip and a correction here. But going to the end of this month, or the end of this year, rather, we've got a little bit over a month left. What are you most bullish on? What is most of your attention and energy going into in the last month of this year here?
Wow. Over the last month, I'm probably most bullish on my son's volleyball team because they've got their state tournament this week, and I think they're going to win. But you guys don't care about that. You guys don't care about that. You know what? Honestly, I know that you're probably wanting like a great idea that people can deploy between now and the end of the year, but I kind of feel like there's times where you should try to make a lot of money, and there's times where you should try not to lose a lot of money. And I feel like right now, it doesn't mean you should sell everything. It doesn't, like I said, you don't need to be hyper bearish, but I think we're at a period of time where we've had a pretty good year. Markets are up. Crypto people have done well. Other than the last couple of weeks, they've had a good year. Precious metals is near its high. Real estate has held up. Stock markets are near their high. I think it's not a horrible time to lock in some gains and just focus on not losing money over the next 6 to 8 weeks.
Words of wisdom as always, Brent. Thanks for being on Milk Road Macro. Where can we send people to find more of you and your work online?
Probably the best way to follow me is on Twitter. I'm pretty active there. If you followed me before, I've probably offended you several times. If so, I apologize. If not, then come check it out. It's at Santiago AU Fund. I love Twitter. I think it's a great place to debate ideas and kind of mix it up a little bit and blow off some steam. If you want to get more involved, though, if you go to research.santiagocapital.com, that is the best way to subscribe to our Substack and our research service. We have 2 different levels there. But in general, we write about capital markets, the intersection of capital markets and geopolitics and the madness of crowds. And I think we're in just a fascinating time in history. I don't know what's going to happen over the next 4 or 5 years, but I'm very certain it is not going to be boring. And so we're trying to stay as on top of all that as we can. And that's what we share with our audience.
Yeah, and that's something I've been trying to impress upon our community and our audience too, that this is a great time for education, to lean in, to pay attention, to not be dogmatic about what must happen, but pay attention to what the market is telling you is going to happen. I've been following you on Twitter for a long time. I like seeing you get into beefs with people. So I'm really happy to finally got the Milkshake guy on Milk Road Macro. I hope we can have you back again. I really enjoyed the conversation, Brent. Thanks for being here.
Thanks for having me.
Awesome. And thank you all for joining us. We hope you all enjoyed today's conversation. So until next time, stay safe, stay educated, stay bullish, and we will see you all on the next episode of Milk Road Macro. Thanks so much for being here, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.